Well, hello, everyone. Hello, and welcome to a special episode for this month of the Royal Nugget Podcast. I am Sharon, your retirement coach diva, and I am delighted to have with me my friend and my tax preparer for the past 12, 13 years. I can't remember, but she helped me out every year. It is always something new that she is showing me, explaining to me, making sure that I am getting all the benefits I can from the tax codes. And so we have with us today Miss Jackie Smith with JASS, which is JAS Small Business Solutions. And she is going to educate us on the different tax laws that went into effect for 2025 under the Big Beautiful Bill. And so make sure that you are taking notes. I know she has a lot of information to share. So if you have any questions, make sure you put them into the chat or the comments so we can see them and be able to, respond to them now. But if you can't get it all right now, you can always go back and watch the replay. And of course, we'll give you Jackie's contact information so you can contact her directly. So, welcome, Jackie, to the Royal Nugget Podcast.
Hello, Sharon, and it's a pleasure to be here this evening.
So, thank you. Thank you. So, before you get started and all that great information, I know you are so eager to tell us all about. Let people know a little bit about yourself.
Okay, well, I'm a native of Washington, D.C. I attended public schools and graduated. I'm a proud graduate of Spingarn Senior High School. During my early days, my school days, under the watchful eye of my father, I began reading those complex tax scenarios while putting pencil and eraser to the actual tax forms. During my pre college days, I would just study the tax laws. It was like a habit. And before long, I began preparing taxes for family members and friends. I received my first certificate from the Federated Tax Program and went on to attend on on-site classes with H&R Block. I attend the IRS tax forum every other year. As a matter of fact, this past year we were at Baltimore, the Baltimore Civic Center, where we get to meet other tax pros and network with various vendors, telling us and helping us along the way on how they can assist us during the tax season. Before long, not too many years ago, I began my own business as a small business owner. And up until now, it's been pretty good for a part time seasonal gig.
Well, I know you stay busy because you're booking clients 2 years in advance. So I know you stay busy.
Well, you learn as you grow. So, without further ado, I would like to talk about the one big, beautiful bill of 2025, which was signed into law on July 4th, 2025. It introduces significant changes to the United States tax code, special programs, and federal spending. Whether you're a dual income family, planning for college, or a married couple with no kids, optimizing deductions, a new single professional evaluating tax strategy, or a new homeowner eyeing solar panels, this law will impact your financial future. What is the one big beautiful bill? I'm glad you asked. The one big beautiful bill, for short, is a sweeping piece of legislation that reshapes the United States financial and social policy landscape. Despite its playful name, the bill introduces serious changes across every aspect of federal governments, including taxes, healthcare, education, defense, infrastructure, and social welfare programs. At its core, the OBBA builds on the 2017 Tax Cuts and Job Act by looking at many of its tax reductions and relayering in new deductions and credits. It also enacts major reforms to programs such as Medicaid, Medicare, and SNAP, reducing funding and implementing eligibility restrictions.
Okay, Jackie. So before you go into your next part, can you just kind of like simplify what that really means to us who do not know? We many of us didn't study the tax law from the time we were 4 or 5 years old. so can you please explain to us like what does that really mean for the average American?
Okay, what it actually meant is before the change of the 2027 tax code, we're sort of like going back to the way it used to be.
Mm-hmm.
I think doing that cut, a lot happened to most of us.
Mm-hmm.
And I'm not talking about anyone probably at 350 or more, 250 or more. But for a lot of us that worked hard for our living, there were deductions we could write off. And the 2017 Tax Cut and Job Act took away a lot of those deductions, calling themselves simplifying.
Mm-hmm.
And in reality, I know quite a few of my clients said, what happened? My refund went down.
Mm-hmm.
And that was due to those cuts.
Right.
For example, the salt tax cut. And you asked me what is salt? That is the state and local taxes. Up
Mm-hmm.
until last year, the prior 7 or 8 years, we were limited to how much we could write off on our state taxes. That
Mm-hmm.
would be taxes withheld from your income for the state that you live
Right.
in addition to your property taxes. If you have multiple properties, that
Mm-hmm.
hurt you.
Mm.
Most people, if they had different properties, purchase a new electric car, well, guess what? You might have had 18 to $20,000 in write-offs in just that one section. However, it was cut to 10,000.
Right.
So the one big beautiful bill rolled that particular cut away and said, oh, by the way, y'all, this only goes on for the next 4 years. We're going to raise that to 40,000. It should have never been cut. Okay, I'm not going to get into my thing, Sharon. It also hurt us when we got to the interest that we paid on our mortgages. Before
Mm-hmm.
this, we were able to write off not only our mortgage interest, but if we had other real estate or property that we owned, be it a park, be it a second home, be it a beach
Right.
home, be it a timeshare,
Right.
along with the mortgage insurance we pay.
Mm-hmm.
Well, due to those cuts, we could no longer do it.
Mm.
So, oh, and let's talk about charities.
Yeah.
There was a limit on charities. And during that 2017 Tax Cut and Job Act, well, now that's sort of coming back to us. So the
Mm-hmm.
things that we did before the 2017 cuts, it's sort of like reverse. The unfortunate thing right now, it's only going to last for 4 years. And then I can't say what's going to happen. It just depends on the administration.
Yeah. Yeah. Because even though it says just post the last 4 years, that is a big impact, right? So like it could affect how, not only our tax returns annually, but how we live in and what we can and can't do or what we have been doing in the past. So um yeah, that's a big thing, even though it says it's only supposed to last 4 years.
And I neglected to mention about the other miscellaneous deductions,
Mm-hmm.
such as the doctors, the policemen, armed forces,
Uh-huh.
whether you be a chauffeur, a stylist, and the things that you need to go out and do the work you do, the parking that you pay under those nice government buildings,
Right.
those miscellaneous deductions were cut too. Now, some of them have come back uh, under certain situations or certain statutes.
Mm-hmm.
One, for example, is if you are a officer for the government, you can get those write-offs on the 2106, Form 2106, or performing artists. And if you have some type of handicap. But the rest of us, we just keep spending.
So when you say an officer, would that mean like someone in the military?
No, that would be someone that is assigned, usually by high ranking officers. That would not necessarily be military.
Okay, so probably like someone at the senior executive service level, a political
Yes,
appointee, something
yes,
like that. Okay,
yes,
okay. And handicap, like or disability, um, isn't that subjective because all disability you can't see everyone's disability. So is there a checklist on like if you have certain types of disabilities?
yes, there is.
Okay. Okay.
There is.
Yeah, that's
I'm
kind
going
of
to dive into that just a little bit more, but I wanted to bring it home.
okay.
Um,
But like those of us, like I said, that are listening, we're not as well versed on the language of the tax. So you're gonna have to kind of
I'm going to
break it
bring it
down into
home. I'm going
plain
to bring it
language
on
for us.
home.
Okay.
Yes.
All right.
So there was also a change to, I talked a little bit about individual taxpayers that itemize. Now I'm going to talk about taxpayers that just take the standard deduction. You have a family, they have an income, medium income, children, and or let's start with the single individual.
Hmm.
So last year, last filing year, which would have been 2024, the standard deduction would have gone up to 9,525 income, earned income, okay?
Hmm. Hmm.
In 2025, the standard deduction went up to $15,750. That is for single individuals. If you're married in 2024 filing season, the standard deduction was at $19,050. For the 2025 filing season, the standard deduction went up to 31,500. So yes, you say, wow, what a big increase. It was there before the cuts. So
Mm.
keep in mind, prior to, they were there because what they did before the cuts was they took your personal exemption, and y'all know what I'm talking about when you could write off $3,600 per person.
Mhm.
Mhm.
Mhm. Mhm.
And they added that to your standard deduction. But during the cuts, they sort of took the personal exemption and added it to it and deducted maybe $1,200. Oh, a few years later, they gave you this thing called a rebate recovery check.
Oh,
Remember that?
yes, yes, yes. I do remember
1,200.
that. Uh-huh. I
Uh-huh.
remember
So
that.
they somewhere along the line they said, "Oh, we better give them a little something, give the taxpayers a little something back."
Right.
So you when you talk about the different filing statuses, yes, that standard deduction did increase
Mm-hmm.
for 2025 through 2028, and then it goes back to what it was prior to that for right now.
Yeah, that's the
Anything
way
can
the law is
change.
written. That's the way the law is written now. So it
That's
could
for now.
definitely change between now and then. So I do
Absolutely.
want to make sure that those of you that are listening online right now, please type into the chat any questions that you might have for Miss Jackie so she can address them while we're online here. Any comments that you might have, please make sure that you type them into the chat so they can be read out, and we will well, I'm not going to answer anything because I do not know this information, but Miss Jackie will be able to answer it. And if you are listening to the replay, if you have comments, you can put them in the chat
Please
as
do.
well. We'll go back and read that. So you go right on ahead. I know you have a lot of information that you want to share.
Okay, so we talked about the taxpayer that itemized.
Mm-hmm.
We talked about the taxpayer that goes along with the standard deduction. What comes along with that is some credits, because there are credits that will decrease your tax liability, and that is what you owe once we figure out all of the income you have and we deduct the standard deduction. Then we have, well, we before that we get to the taxable income, and then we deduct the standard deduction, and we have what you call a tax table, where you will know what your tax liability is, and that is what you owe.
Mm-hmm. Okay. So
There's
we
some,
have a go ahead. Go
some
ahead. I was gonna say
I was
that
just
once
going to
you
say,
did that, I'm gonna go to the chat. We have some comments. Go ahead.
okay. So what I was going to say is, let's listen to the comments.
Okay, so there are actually questions. So the first one is, what is the 2025 standard deduction for singles?
Okay, the 2020, that's a good question.
Mm-hmm.
The 2025 standard deduction for an individual that's filing single is $15,750.
That
And
sounds
it
like it's a,
goes up to $578,125.
so can you like briefly explain what does that mean um, in order like when you are filing your taxes, because that was a difference from what you told us of almost $6,000 of what it was before. So what does that mean for the average taxpayer?
The average taxpayer, if they're filing single, and I have to give you a scenario, I'm gonna give you a quick one, and their income is $30,000.
Mm-hmm.
Your standard deduction would be $15,750. So there is a range based on your income. There is a range, and that range can go from $15,750 based on your income
Mm-hmm.
up to $578,125.
And so what does the standard deduction actually do when it comes to preparing taxes and everything?
For the individual that used to itemize, and let's say someone has decided they don't want to itemize anymore, they want to downsize, their
Mm-hmm.
income is too much trouble trying to pull all those different type of receipts together. You're
Right.
constantly running back and forth to your tax preparer's office.
Yes.
They just take the standard deduction. I've seen taxpayers that would like to take the standard deduction, and
Mm.
this year actually has been more advantageous to them.
Okay.
So I
Okay.
take the time to do both.
Okay. Okay. Great. So the next question is there a difference for business regarding deductions?
Is there a difference in what manner?
I'm assuming for the standard deduction
No,
or
an
the type of deduction.
individual. It depends on the business type, but an individual is an individual.
Okay.
So I can use myself. I'm a business owner. Most of my deductions would come from my business side. But as far as my personal side, it will still fall under this table again, based on that adjusted gross income. So
Okay.
there are some things that go on in between.
Okay. Okay. All right. Well, again, I know you have a lot of information that you want to share, so you, I'm gonna turn it back over to you.
Thank
Oh, I
you.
do have another question.
Okay, okay.
Okay, anything new under the big beautiful, under the big bill on deductions for businesses?
I'm going to get to that. I
Okay,
do
and
have some things, um, but I'm going to get to that. I just want to build up to that. Can
okay,
we
and
come
then
back
the
to
other
that, Sharon?
question. Yeah,
Can we
sure.
come
And
back
the
to
other question is, what is the income amount for the standard deduction of $587,235?
I don't know. I don't know nobody to make that kind of money. I haven't. I
I would
haven't.
think they would have a standard deduction, really, but
Yeah, you would think that would just phase out after a
yeah.
time. Yeah, that standard deduction is really based on income.
Hmm.
Okay. I was beginning to talk about what happens when we get to our tax liability. And our tax liability is what we pay after the standard deduction, after the itemizing deduction. Then we want to say, okay, how much? And most taxpayers want that number to be as low as possible, if not zero. So there going to be some things that they call refundable credits and non-refundable credits. Your non-refundable credits would be things like your child tax credit. So we talked about the child tax credit being $2,000 per child, and that is under the age of 17. There's also the dependent care credit. I haven't seen much change to the dependent care credit, but oh, there was a $200 increase in the child tax credit. So the individual with a tax liability of, I'm going to say $2,500, and they have a child, that's the key. Your child, an American citizen born here in the US of A, under the age of 17, you get a credit for $2,200. That's going to take that tax liability, that $2,500 tax liability down. We'll subtract that amount. And then if there's dependent care, take the baby to the daycare provider, you also get a credit for that.
Hmm.
And it can actually bring you down to a zero tax liability, which means if you had taxes withheld throughout the year, your liability is zero due to those great credits. For the seniors,
We see you. We see you.
there was a $6,000 credit provided.
Okay.
So that credit falls up under your tax liability, and
Okay.
that will be deducted as well.
All right. So we have another question that says there are a lot of people who became unemployed after the new administration's changes regarding the federal government and Doge. Are there any tax credit for this when we file taxes for 2025?
When you if you became unemployed, are you receiving unemployment compensation?
we have to wait for this person to respond
Okay,
back. And if you
so
and go ahead.
no, you go ahead, Shannon.
No, because it
Oh,
sounds like you
okay.
want to say more.
Okay, so you're right. I
Mhm.
empathize with you a lot. Um, I have not seen any credits or any stimulating money coming back to those um, that were on the receiving end. I have heard different scenarios where federal workers that decided to retire, they're waiting or have began getting their retirement benefits. So they were unemployed for a while. The individual that was not a civil servant, let's say you worked in private industry and became unemployed because there were no more people to come and buy those goods. I have not heard of any relief as of yet that
Hmm.
can come your way other than unemployment compensation. But let's say you worked for an organization that did not provide that. I have not, other than unemployment that varies by state. You would have to go to your state and ask them what relief can we get for losing our jobs.
Okay, okay. And could you just go back a little bit and um, repeat what the standard deductions for singles are?
Okay, let me just say what I have here. An individual with an income from 0 to 15,750. That standard deduction, I see what the question is. That standard deduction is capped at, I want to say, 12,500. I would have to actually look at a return.
Okay, okay. That's good information. That's good information. So the person said that was responding about the Doge. They said yes. I'm assuming that they meaning that they did lose their job, and they probably were not eligible for
Unem-
retirement. That could be. So, um, so based on what I remember you just saying, that there are no, there's no relief.
I have not heard of any relief for anyone that lost their job other than the organization that they worked for. They have
Hmm.
the option to draw unemployment. They
Right,
can draw down on their retirement. If they're
right.
under the retirement age, then that's where the penalty comes into play. It's very similar to, remember when we had COVID and a
Mm-hmm.
lot of people had to leave the office. They had
Right,
not had the work at home in place set up.
right,
So people start tapping into their resources, their
right,
savings.
right,
Now,
right.
and then everybody started getting laptops. To me, that was a wonderful way of organization, federal agencies assisting with people keeping their jobs and not
Right.
having to tap. But if they did tap into their resources, they had 3 years to pay it back. Now, again, those are tied to some restrictions. It had to be a retirement program that was under a federal guideline.
Mm-hmm. Okay. Well, that sounds like it's even more detailed information that I don't know if we have time to go all into that in what you have to offer. So that means that those who have questions need to reach out to you directly, and I'm going to make sure that they can see your contact information here on the screen. So if you have any more detailed questions that you want to ask Jackie, please reach out to her at JASSILDY That's JASSILDY And she'll be happy to maybe set up a consultation with you and be able to go over your questions that you might have. So continue, Jackie, on educating us on. I know you can't go through everything that the bill talks about, but as much as you
Well,
can
maybe
for
we
us.
can have a part two. But let me tell you what I found here. The OBBA made several permanent provisions from the TCJA. That was the tax cut before, back in 2017.
Okay.
The income rate maintains the current tax bracket with a top marginal rate of 37%. What does that mean? Standard deduction increases the standard deduction to 32,000 for married couples and 16,000 for single filers from 2025 to 2028.
Mm.
Okay. Remember, I talked about that senior deduction that introduces an additional $6,000 deductions for individuals age 65 and older,
We
applicable
see you, Jackie. We see you.
2025 to
I'm still on
20.
the baby senior side. I haven't even got to the teen
I
senior
know
side.
you have
So
some
I'm
time. So by the time you get there, this will be over.
I'm
So this
praying.
only
I'm
lasts a
praying.
little while.
I'm praying.
Okay. It looks as though the child tax credit increased by $200. So per qualifying child for 2025, with future adjustments for inflation, the credit phase out for married filers with a mega over 400,000 and single filers over 200,000. So what does that mean, Jackie? That means if your income is that amount, you don't get the credit.
So wait a minute. Can you go back? So if the income is over how much?
If the it says here with future adjustments for inflation, the credit phases out for married filers with a mega income over 400,000. So if you're married and you're making $401,000, you don't qualify for the credit. And single filers over 200,000, you
Wow.
don't get the
Wow.
credit even though you have the child.
So that. And so I'm going to say this: like for the average American, that is not a salary that they're going to have. Like the average American married two income household is not going to have a salary that's over 400,000. And for someone who's single is or filing single is not, they're
With the
not going to have
child.
with
Yes.
a child, not going to have a salary over 200,000. However, there are geographical locations where that could be a big issue.
That's right. That's right.
Yeah. Depending on where you live and what you do, that could be a big issue. And even if there's someone who works part time, or receiving income from other streams, and all that's included in their taxes when they're getting it prepared, then that could be an issue. So yeah, so keep going, keep going. Tell us more.
Okay. I'm going to talk a little bit about, and I know you all have heard about this new car getting for the first time in decades. Okay. The big, beautiful bill allows deductions for interest on new car loans. But there is a caveat, it
Okay, what's
has
it?
to be an American made car.
Oh, oh.
So
Well, I
don't
mean, how many people can afford new cars nowadays?
US assemble. Now they do have
Okay,
we do have some cars that have German manufacturer or British manufacturer that are assembled in the US.
so that's what it means. It means that it has to be
Yeah.
assembled in the U.S., not necessarily. So it's not a U.S. company, but it has to be assembled in
It
the
just
U.S.
says US assembled vehicles. Now when they start using that kind of language, that can change. I had a client that purchased a, those cars I could never afford, a Tesla.
Mm-hmm.
And because it was an older car, it was an electric car, but
Mm-hmm.
because the model was of a certain type, he could not take that right off. So
Oh.
when you say US assemble, you want to talk to your salesperson about that caveat.
Hmm. Okay.
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 If you're planning to buy a new car, confirm it qualifies under the US assemble requirements to take advantage of this limited time deduction. Typically, if the VIN number starts with a 1, 4, or 5, it indicates that the vehicle was made in the USA,
Okay.
is a US assembled.
Mm-hmm. Okay. Okay.
One of the other nice things that happened is the standard mileage rate. There was an increase for 2025 for the standard mileage race. For the business user, that was
Mm-hmm.
70 cent a mile.
Oh.
And for the individual that uses their car for volunteer purposes, that rate is at 14 cent a mile. Okay. And the 2025 rate for operating a car for medical reasons is 21 cent a mile.
Okay, so let me go back. So I understand about, operating for a business, but I didn't know that you could claim mileage if you're doing volunteer work. Now, does that depend on the type of volunteer work, or you can just say you're
It's
doing?
usually for a volunteered organization.
Okay. So like if I am doing something for the church, I can claim that.
Well, that can get a little sticky. Okay,
Okay.
so if you go to the
Hmm.
state usually regulate those type of things.
Okay.
So
Okay.
let's
So,
say the church decide to ask 12 members that may have very large vehicles to
hmm.
transport the members from one location to another or to
Right.
go on a trip. I
Right.
don't know if that would be considered charitable, but in our hearts it is. I'll look that up and get back with you. That was a
Yeah,
great,
because I'm thinking about my son was in the Boy Scouts, and I used
yes.
to
You was a
help
den
him
mother.
transport, the equipment and things like that. Even before that, when my sons were playing sports, and I would help do things. I was volunteering, so that um, that made me think. And then the next one that you had said, what was the one after volunteer?
That was the one for medical purposes.
Okay, okay, so
So you get
so
21 cent a mile for that.
So what does that mean? Like
Okay,
who will
so
be
I have to
transporting to the
drive
next
my
one?
I interpret it as meaning I'm driving myself to see my dentist. I'm driving myself to see my primary care doctor.
Oh, okay. So anytime that we're going to a medical appointment,
It's
if we
medically related. We can
right
get to write off those
for
expenses,
our
that
for
deduction
ourselves or for someone else.
for
Like if we are
ourselves.
transporting someone else.
When you file your taxes, you file it for yourself.
Okay, what if they're our dependent? Then we can do that.
I would think that's part of your tax package, your head of household. So that would should include your dependents. But that's another one I'll get back on you. And I'm glad you're asking these different type of scenarios because it can be complex.
Right. Yeah.
It can
Yeah.
be, there are some gray areas. So it can be a little complex. But
Yeah.
I would take it that way.
Yeah. Because I'm thinking about, did I miss something?
Yeah, look, we missed a lot.
Yeah. Yeah.
As time go on, I mean, as I sit down and I engage with new clients, they're surprised and I'm surprised that they're surprised.
Mm, hmm.
And that's
Wow.
why part of my business practice is consulting. I like to talk about the changes in tax. It's a very, very interesting topic. And depending
Yeah.
on what side of the table you sit on and what state you're in, there
Right.
are a ton of things that I am learning.
Right.
Oh my God. there are a ton of things. I
Okay.
urge everyone, let me say this before we get too much further into the video. I encourage everyone, no matter where you live, please pick up that state book and look at those credits, look at those deductions. You would be surprised what you're missing out on.
So just so our listeners and audience know, you well, I'm not going to assume. Tell us the type of clients that you service.
Individuals and small business owners. I have worked with small business owners that had partnerships. And that was a very eye opening experience. There are small business owners that receive income from organizations such as Uber. Uber does a great job. When they first started out, they didn't do as well as they do now, but they do check your mileage. I mean, they track your mileage, they
Mhm.
track your runs to and fro. There are people that work for Uber and Lyft that probably isn't aware that they can get that information, but they can.
Okay. Okay. Great. And as far as companies, I know you said small businesses, but do you work with nonprofits as well?
I have had the opportunity to work with two wonderful nonprofit organizations.
Mm-hmm.
And in doing that, as well as working with some of my clients that are pastors and ministers or ordained deacons, deaconess,
Mm-hmm.
I have learned a lot about the things that are special exemptions for them.
Okay.
So, yes, I have worked with nonprofit and profitable, um, ordained
Okay.
individuals.
And most of your clients are located where?
Most of my clients are located in the MDV, but
In
they have moved on. They have retired. Some have moved to California.
uh-huh.
Some have moved to North Carolina. Some have moved to Florida. And guess what? In Florida, they ain't got to worry about no state tax.
Okay.
But
Okay.
we do work interactive. So
Hmm.
we, those clients that have moved, I still work with them.
Okay. Okay. But the majority of your clients are in Maryland, DC, Washington,
In
DC,
Virginia,
and
yes.
Virginia. Okay.
Yes.
Awesome. Awesome. Yeah, we want our listeners to know that when they work with you, what states you're familiar with when filing your taxes. Not that you probably wouldn't work with someone anywhere, but we know that you have expertise
And let
in
me tell you
for those
something.
areas.
I learn a lot from my clients. They come to me and they say, Jackie, did you know about this? And did you know about that? And I'll say, what? Let me look into it and I'll get back with you. So
Hmm.
I learn from my clients. I think we learn from each other.
Yeah, yes, you teaching me something every year. Every year I go to you, I'm learning something that I didn't do, supposed to do, should have done. And so, but we've gotten better. I say
Yes,
you
you
have
have.
taught me a lot on making sure that
Thank
I'm
you.
organized with everything. So, but we have about 15 minutes or so left. So let's give some
Let's
more
continue.
information. Yes.
Okay. Um, the estate tax exemption increased. Starting in 20, well, I'll say it will increase. Starting in 2026, this year,
Hmm.
the federal estate tax exemption will rise significantly to 15 million per individual, 30 million for for married couples, up from the 2025 tax year 2025 limit of 13.61 million. Um, I'm not that wealthy. There's this account, and I don't know if you all heard about it. It's called the Trump account. I
Yes,
have to
I've
look
heard it.
into this. Have you heard of it?
I have. It's where, if I'm remembering the correct one, it's where parents can put money aside in an account like a 529
Yes.
account,
Well,
and
you
but
got,
the
yeah, you
children
have
have to
the
be
529.
right.
Yes.
So the children have to be born within a certain time
Yes,
frame.
between, guess what? 2025 and 2028.
Yeah, yep. And they give. I think I heard it was like $8,000 or something. I'm not sure if that's the correct amount, but it's at least 5,000
Well, I know
towards
they will
that.
receive at least 1,000 is government
Okay.
is funded under the Trump account. And it
Okay.
is, like you said, a new savings vehicle.
Right.
So let's see what else I discovered. This is one I know everyone is happy to hear about. No tax on overtime.
That would be good for those who work a lot of overtime.
But guess what? It's a limit to that too.
Oh, okay. Okay.
So let's say you work $35,000 worth of overtime. I don't know how that calculates,
Mhm.
but
Mhm.
there you can write off up to $12,500. So because it's almost like helping. Remember, I talked about that tax liability.
Right.
It sort of helps in that area, so it
So,
lowers your tax liability.
right. So our W-2s do not break down overtime separate from base pay.
Now, I believe that because this particular I don't know how to say it, but it was going through congressional changes.
Mhm.
So I don't know if the payroll companies had enough time to fix that. The software houses I know were going crazy. And most clients, we had to tell them to keep their last pay stub of the year and bring that
Right.
into us.
Right.
Um, it should show up on your W 2 in box 14 of your W
Okay.
2.
So for 2026, it may be separated out, but I mean for yeah, but for 2025, it probably wasn't, and you had to have them pull the um,
Yes,
last leave and earning
the
statement or pay
last
statement
leave
for
and
the
earnings
tax year
statement.
for the tax year. Okay.
Right.
Okay.
So if you earn qualified overtime, you are eligible to deduct up to $12,500. Married filing jointly, that would be $25,000.
Well, what's qualified overtime? I mean, how is that determined?
I guess that's based on your employer. I mean, to me, overtime is overtime. I work overtime all the time during the tax season. So,
I know you do. I know you do. So that's
um,
interesting to see what that means. Qualified overtime.
yes, yes. And then getting back to that no tax on car loan interest.
Mm-hmm.
If you paid or accrued qualified passenger vehicle loans in the interest on the vehicle you purchased in 2025 for personal use, you may be eligible to deduct up to $10,000
Okay.
of that interest. So I know, Lord, I open my mouth. I know I'm gonna have my clients coming back and say, Miss Jackie, you didn't tell me that. I'm learning all the time. Remember the salt tax? We talked about that increased from 10,000 to $40,000 with a 1% annual increase. Okay. And it will revert back maybe after 2029. Charitable contributions, the OBBBA modifies and expand the rules for charitable deduction, temporarily increasing incentives for giving. Starting in 2026, you can deduct up to $1,000 individually, or 2,000 for married filing jointly. And these are cash charitable donations, even if you don't itemize. Isn't that sweet? Miscellaneous deductions, which I talked about at the top of the hour, uh,
Mm-hmm.
those deductions for most miscellaneous itemized expenses, such as fees for investment advice, tax preparation fees, um, they've been permanently suspended.
Okay.
So as you go through the year and talk about your tax planning, I tell my clients, keep track of your receipts keep track of your expenses because you never know.
Mm-hmm. Mm-hmm.
Okay.
So,
We
we got about 10 minutes left. I did want to ask this. So you've given a lot of information. I'm sure your emails get ready to be flooded with questions of people contacting you.
okay.
But um, I am thinking that there are going to be some people who are going to go back to their tax preparer
Yes.
and ask about these questions to determine whether or not they, um, got the deductions. What? But then there are a lot of people that prepare their taxes on their own through TurboTax or whatever the platform is. They may not be aware of how all that worked for them. So, what would you recommend that they do in order to make sure that they um, know whether or not they got the correct deductions or things like that?
Okay. There is a publication for the individual. It's called Publication 17. It is provided by the Internal Revenue Services every year. That is like your little pocket guide. It will tell you individually everything you need to know. And for our business owners, there is the Schedule C. It is a small business guide that you can look at, and there's a ton of information. I learn as well as, you know, practicing. So,
Mhm.
and also, even when I learned something, and that was the question I think you was getting after, Sharon. Let's say someone finds out next year that they could have written off something, you know what I'm saying, in the prior
Mhm.
year.
Right.
Your preparer knows how to do an amended return to get you those things, um, and to get you those credits. This country is well endowed, trust me, and your contributions is not going to hurt them,
Mhm.
because you know what we do in America. When we run out of money, we just print more.
That puts us more in debt. But I
And they
do have a question. I have a question in the chat for you. It says seniors 65 and older get a okay, get a $6,000 deduction. Is that correct?
That's correct.
And if so, okay, and if so, if we use TurboTax, are these things programmed into those type of platforms?
Those platforms should have it, because one of the things that they ask you when you're beginning to do your interview form is your age.
Mm, okay.
So, based on the age, like I explained about the child tax credit,
Mm-hmm.
there's certain criterias that must be in place. That's the same thing for us sweet seniors. They're
Okay.
going to look at your birth date and say, oh, that taxpayer qualifies for $6,000, and it will automatically pop up.
Okay. Okay. Yes. Well, you know what, Jackie, I know you have a lot more information that you can share. We have about 6 minutes left, and you threw out there about doing a part two. So, and what I'm thinking is, it's getting close to the end of the tax year. We're going to see if we can get you in before the end of the tax year, because I know your schedule is getting even busier as we get closer to April 15th. However, I know that there's also things that you could share based on what you saw for 2025 filings and what people need to be aware of, like mistakes and things that people missed when they were doing 2025, and then how they can get ready for
Yes.
2026. So I would love to have you come back to us and share, like, these are the mistakes that I saw, these are the errors or the
Okay.
things that I saw,
Love to.
and then this is how you can prepare as an individual, as a married couple, as a business owner for 2026. How's that sound?
That sounds wonderful. And Sharon, can I sneak in one more thing?
Oh, sure, sure.
Okay, y'all. So, I went there. There is this, let's say you are a homeowner and you had to put in a new furnace, or you had to put in a new hot water heater. It is called the residential clean energy credit. But starting this tax season 2025, you have to know the qualified manufacturer identification number. What? Yes, that is a four-digit number, not where you bought it from,
Uh-huh.
not who the contractor that put it in, but the actual manufacturer that made that unit. That's the only way you're going to get that credit now. And that manufacturer is on the IRS website. So all you have to do is Google QMID, Qualified Manufacturer Identification Number, and it will lead you straight to that.
Okay.
Particular
Okay.
section.
So you gave a lot of information, and people that are listening now, you can always re-listen to this, you know, on YouTube. So you can go to Royalty Business Group YouTube channel and listen to the information again. There were some things that were repeated, but there are also some things that we just, you probably have to stop, write it down, listen again, stop, write it down. So make sure that you are doing that, or you can reach out to Jackie directly. Again, her email address is JASSILDY@gmail.com. JASILDY@gmail.com. And just ask her these questions that you have, because she is, as you can see, extremely knowledgeable and will be able to talk to you based on your particular situation. And it doesn't matter where you are in the United States, because federal law is federal law across the
Federal laws.
United States and its territories. So make sure that if you have any specific questions about the federal tax laws, then you can contact Jackie. And if you're in the, Washington, D.C., Maryland, or Virginia area, you can reach out to her as well, and she can be able to assist you with state taxes as well. So, Jackie, I want to thank you for sharing your expertise. We're going to schedule a part 2 as soon as
Thank you.
possible, so you can be back to share the do's and don'ts and how to prepare for 2026 tax year. And as always, I appreciate all the hard work that you do, making sure that I am compliant with
Yes,
my
to
taxes.
God be the
And
glory. I tell
yes,
you.
yes, we came a long way.
Oh
We
my
come a
Lord,
long
yes.
way.
To God be the
Yes,
glory.
I do appreciate you, and I appreciate everyone that's been online today. My ex, I can't even talk now. My next episode will be on April 8th. So just look out for the information and the flyer, so you can be able to join me and my guest on April 8th as we talk about. We're going to be talking about insurance and health insurance, life insurance, long term care. And so you can see how you can make sure that you have something to add to what you already have, to supplement it, or maybe replace if you need to. So thank you again, everyone, and have a great evening.
Thank you.